Good evening or good morning. Welcome to the Market Mondays webinar from Capital.com. My name's Kyle Rotter. I'm with Danny Haythorne. Danny, how are you this morning in your part of the world?
Good morning, everyone. I'm good, Kyle. Just ready for another week of markets and data, and yeah, just to take everyone through what to expect.
Yep, absolutely. Another week of low volatility, perhaps. It's been a little bit painful, really, but we're going to talk about some of the opportunities there and what's moving, obviously. Let's just go through the risk warning very quickly. I'll start just by saying that everything that you hear here is of general nature only and does not take into consideration anybody's personal circumstances. CFDs are, of course, risky products, and you should consider your risk profile before trading them. Danny, obviously, you've got something extra to sprinkle in there as well.
Yeah, just be aware that, as we said, CFD products are complex products, but also in the UK, we offer spread betting, similar risk profile. Just make sure you are aware of how the product works and the risk involved before you trade them with Capital.com.
Absolutely. This is just a quick overview of what we'll likely talk about, but we'll start perhaps with US inflation data, then we'll kind of run through some of the moves in the markets and go to obviously previewing what to expect from this non-farm payrolls figures at the end of the week. And, I'll sprinkle in as well just a quick word on the RBA, which is tomorrow our time. Bit of a nothing burger, but worth raising. But I mean, to start with the inflation figures, Danny, pretty much as expected, right? And I mean, for me, the takeaway is that inflation is above target, but it's at least for the second month in a row, steady at around 2.9% for that core figure, and probably doesn't really change the view tremendously that the Fed is in the position to cut rates in October and December.
Yeah, I think that's definitely the key takeaways. Inflation is not ideally where markets and the Fed would want it to be, but I think the fact that it did pretty much come in without surprises was a positive for market sentiment. We saw that in the way equities performed. They reversed higher once the data was out on Friday afternoon. And that was after a week where we saw a few sessions of downside, triggered mostly by those comments from Powell and other FOMC members that they didn't push back on rate cuts nonetheless, but they did kind of give this once again caution view into it is still a meeting by meeting approach, and that no rate path is set yet, and everything's going to come as the data instructs. So the PCE data just served to, I guess, price out some of those concerns about another resurgence in price pressures, but of course, the PC data wasn't bad. It wasn't great. It leaves things pretty much as is. Market sentiment has recovered, but there is going to be a lot of focus on this jobs data this week because, of course, markets still want more concrete evidence that the Fed is going to continue cutting.
Yeah, maybe we'll just have a quick look at just what the FedWatch tool is telling us at the moment. But I think you're right, Danny. Obviously, there is the sense that inflation is above target, but it's not charging away from it at the moment. The Fed has signaled in the past that it's willing to tolerate a lift in core inflation to, maybe even the low threes and still cut interest rates. And there was even talk, with the kind of cautious tone coming through from some of the Fed speakers last week, Powell in particular, about being, data dependent or somewhat data dependent, is even this kind of slightly more highbrow, abstract conversation about, a future that maybe there might be a target band for the Fed of 2 to 3%, because as I see it, there is this kind of sense that the Fed is, happy to be 100 basis points away from its inflation target if it means that it can support the labor market, or at least it's willing to tolerate that so it doesn't have to undermine the labor market. Markets seem to be really buying into that notion. The cynic would say that, what the hell is the Fed doing? Inflation's at 3%. They're cutting rates into that. That's wild. But, the future will tell us whether that's a policy mistake or not. But, as you were saying there, Danny, 90% chance of a rate cut in, October, basically discounted. And then December, that's moved, interestingly enough, to around 68% chance of another cut there. So maybe watered down very slightly, but the curve is still indicating some fairly significant dovishness, and that's kind of the cue for the Goldilocks kind of rally that we're seeing at the moment.
Yeah, I think what's interesting as well towards the end of the session on Friday, something that might have also ignited a little bit of that extension of the rally and also to today's session. Remember that in the July meeting, we had two dissenters for a jumbo cut. One of them was Michelle Bowman. However, in the latest meeting in September, she did not vote for 50. She kind of followed the general consensus and voted for 25. And that kind of gave markets the view that, okay, so the Fed is trying to be a bit more measured and take it a little bit slower, step by step, just to make sure they're not overstepping and therefore stimulating inflation to pick up once again. However, on Friday, Bowman said that the recent data that we've seen is materially more fragile than expected, specifically in the labor market, and that inflation, excluding tariffs, is hovering not far above target. So she was saying essentially that if the Fed does not cut significantly over the next few months, that they do risk falling behind the curve, and that could be to a detriment of the US economy. So it kind of feels like she was, I wouldn't say backtracking on her decision to cut 25 at the meeting, but I think she was just trying to give a little bit of context around, what her views are and how she views this going forward. She is a voter, so of course something to take into account, but it's interesting because I think that might have been fueling the rally a little bit more. I do still think that, as you said, cutting with inflation pretty much at 3% is risky. The current rate allows enough wiggle room for the Fed to cut once or twice, but we are getting to that point now where the Fed is likely looking for concrete evidence that they can continue cutting, and things like the PCE close to that 3% range is something that's going to potentially put a spanner in the works. So seeing commentary like this has likely driven that momentum in equities higher this morning as well.
Yeah, for sure. And maybe just before we close the CME group page, just for another day, just take a quick look at, where the markets are basically implying rates to go over the next, say, 12 to 24 months. And once again, it's still indicating that the Fed is poised to cut rates to about 3%, which is sort of notionally in below neutral and in expansionary territory. And that, may be a big reason, pardon me, while the lights turn off, but that probably is one of the big reasons why we have, again, things like stocks as well as gold rallying simultaneously, almost to record highs. Maybe, Danny, let's move on to that quick discussion about gold, just because it hit another record high today in the Asian session. And there's a multitude of reasons why this is occurring, but chiefly, like we said, it's maybe a large pinch of interest rate expectations, but also there's those, questions around sort of Fed independence as well. There was that interesting, I don't know if you saw it, Danny, that interesting Truth social post of the cartoon of Trump firing Powell.
Yeah, I think at this point, markets, I don't think they're going to take it at face value just yet. I think we've seen so many instances where this has been hinted or thrown about that, Trump will be maybe firing Powell. I think at the point where we are now in his term, we've got, 6 months left to go. I don't think it's realistic, and I think markets aren't discounting that as a real risk. But of course, the Fed independence debate goes beyond that. It's not just what's happening with Powell now and whether he's going to get fired or not. It's what comes next, what comes after Powell. We've talked about this quite a bit. Is the next Fed chairman going to be significantly more dovish because it's going to be influenced by the US government, and therefore that's where that independence debate comes in. So that is a risk for equities, and that does push gold higher. But as well, with the US jobs data that we have on Friday, there is some follow through in risk appetite that could come from it. But I think stocks have more to lose than gold, in the sense that I think reading that's in line or a little bit softer than expected would be constructive for both equities and gold. However, if we saw a disastrous print or something that's much worse than expected, I think gold takes advantage of that, but equities would likely falter a little bit, as that of course points towards a more pessimistic outlook for the US economy. So I think gold still has the upper hand this week when we compare it to equities, considering the data that's coming out towards the end of the week.
Yeah, and you can kind of see they're pushing to a new high. There's a pretty clear sort of level of support as I see it in this kind of upward trend channel currently guiding gold higher. So it's a very difficult trade to bet against. Obviously, there's probably a lot of good news already baked in, but so many sort of structural drivers there. Danny, it looks likely as well that we'll just maybe shift to the S&P 500 and then maybe talk about US indices too, that there's just so much strength behind the market at the moment. All these kind of fears, I don't know if you're hearing them very much. You can confirm in a second, Danny. All these sort of fears about, bubbles and, imminent crashes and market complacency. Perhaps we'll talk about it shortly too, that, the VIX is taking a dive once again after this inflation data was, pretty much in line with expectations. But for all intents and purposes, from what we can see at the moment, the market just keeps wanting to push higher. And I do note the bounce off the 20-day moving average last week as well. We're only a few pips points away from record highs. We break that, it's a very bullish signal.
Yeah, there has been a lot of talk about this bubble, as you're saying, and we are actually doing a piece on that, which I think will hopefully be up this week or next week. So we might be able to reference that in next week's webinar. But it's interesting because a bubble, by definition, is essentially when the price of an asset, in this case stocks, kind of goes beyond what fundamentals justify, right? And I think there's been a lot of concern about that. But if you're looking at the growth in the S&P 500, specifically as a benchmark for the US equity market, and you look at the growth rate in earnings, they're not that far off each other. So the price to earnings ratio hasn't changed pretty much at all since the beginning of the year, even though equities have continued to move higher, because earnings have kept up that pace of growth as well. So this is, of course, a different debate, but those concerns about bubble may be lacking some sort of fundamental. However, when we're looking at the charts specifically, something like the S&P 500, of course, last week's downside pressure helped to retest some of that overbought conditions. So there is more wiggle room to push higher. It's a case now of how do we break that resistance and what's going to be the next driver. We have a few things on the calendar, as we said, the PCE being the key one. As I said, if it comes inline or a little bit softer. I say inline because inline already suggests that the growth of payrolls in the US is much lower, has been much lower in September than the rest of the year. So if it comes in line with expectations or even a tad softer, I do still think we have more appetite in US equities because it plays into that notion that the Fed is going to cut definitely next month, but also I think the last meeting of the year, which will be in December. If it comes in disastrously low and it starts pointing to a weaker US outlook, then that's when we see potentially that indecision in equities. Because on the one hand, it does free the Federal Reserve to cut further, but on the other, at the end of the day, if the US economy is expected to soften, specifically because of labor market issues, then that doesn't bode well for future earnings either. So there is kind of a double-edged sword for US equities with this data. It just depends of how far away from expectations this data comes. And something to watch out for as well, of course, that unemployment figure is expected to remain unchanged, even though we do have less jobs added. And I think, Kyle, if I'm not mistaken, that has to do with the fact that Trump's immigration policies are expected to have reduce the pool of workers in the US, right? So the figures may be a little bit skewed on the back of that.
Yeah, and there was some talk from some Fed officials last week that it might have been Goolsby, I can't remember, but that they think the break-even rate for employment, which is effectively to say how many jobs need to be created to keep the unemployment rate steady month over month, to keep up with increases in participation and demographic things, is about 25 to 50,000 jobs, and we're expecting around a 51,000 employment increase at this particular NFPs, which should keep the unemployment rate at 4.2%. But it should be fairly interesting. I think there's a lot of sort of risk skewed to the upside there, because I think the only thing for me that would really be disastrous for the markets is if we get a significant downside surprise. If we get an upside surprise, the labor market is strong, happy days, the US economy isn't slowing down. If it's a sort of an inline print, we all carry on because that's what we expected. If it's slightly softer than expected, more rate cuts, hooray. But if it's really, really weak, hypothetically, and I don't think I haven't seen the full spectrum of forecasts yet. I don't think there's anyone forecasting a contraction in employment or anything of that nature. But if we got a disastrously weak print, perhaps that would start to raise some concerns that the Fed, as we've spoken about in the past, Danny, is behind the curve and has been too slow to ease policy to protect the economy. Maybe that's when we'll start to see some real fear emerge in the markets. But anything less than that, then I think things are going to sort of continue to sort of push higher on that kind of a basis. Danny, maybe we've kind of just knocked off the NFPs chat. We can push on just a little bit, perhaps, to the oil conversation too, and I can start with a look at the charts, maybe. because we had a bit of a rebound last week, back towards that sort of 65 level. But I don't know if you've seen the news today. It looks like OPEC, it has been since denied by the cartel, but OPEC could be continuing to increase output again in November after what will be an increase in output in October too. And it seems to have, one, led the price to sort of reject, what's that, the 200-day moving average, I think. But perhaps we could come back to this very critical level around, maybe $61.50 on the WTI benchmark, which for me seems quite inevitable considering that we are getting slower growth out there and we still have OPEC seemingly on the side of the fence that it wants to increase output rather than reduce it to support prices.
Yeah, and we also had a story last week, which was kind of one of the key drivers as well of some of the weakness towards the beginning of the week, and that was the news story. I think it was Iraq and Kurdistan that are planning to reopen their pipeline via Turkey, and therefore they would add, I think it was roughly 200,000 barrels per day that would flow into the inventory of oil. So that again weighing on prices and seeing a little bit of a shock to the market there. So I think a lot of the drivers in oil right now are that supply side, because the demand side has remained pretty stable. I think we do have some concerns once again stemming out of China because there's some weaker economic data there, and China is one of the biggest consumers of crude. But I think a lot of the data, a lot of the drivers behind the move in oil are these supply stories. And of course, any stories like OPEC introducing new supply or any new pipelines opening after a period of being closed and potentially flooding the market once again with excess oil, that's likely what's going to continue to drive oil prices lower.
Yeah, and again, that sort of 61.50, maybe a little bit lower, depending on where you want to sort of draw your support line, is pretty crucial for me because if that breaks, well, we bounced off it about three times. I think that could, herald a little bit further downside, maybe sort of retest that kind of $60 per barrel mark. Danny, before I talk about the RBA and then maybe we throw it open to some questions, any sort of pet topics in your part of the world that you think might be relevant this week? Because I think there's a little bit of data, but it's certainly not very high impact relative to perhaps the United States, for example, when it comes to event risk this week.
Yeah, no, we have a few regional CPI readings in Europe. Nothing too significant. We'll have to wait for the actual CPI reading for that, which always comes at the very beginning of a month in the Eurozone. So on Friday, we'll actually have the CPI data. No, sorry, on Wednesdays, my bad. Wednesday the 1st, we're going to have the CPI data for the Eurozone. Not much change expected. I think core CPI is expected to remain unchanged around that 2.3%. We might see a slight uptick in headline CPI. A lot of it actually coming from higher food prices that we're seeing across Europe. So something to watch out for, of course, for the European market, but nothing too significant other than that. We do have the US ISM data, the manufacturing and services sector PMI. I think both are expected to come in a little bit definitely the manufacturing is expected to have increased a little bit from the previous reading, and I think the service is expected to come in unchanged, but above that 50 line, which marks the contraction expansion era. So that data will also be important, I think, specifically for the US dollar. I think we may see some sensitivity midweek for the US dollar on the back of that ISM data, whether it comes in line with expectations or not. But other than that, I think the story this week is going to be focused on that US jobs data, which is going to be driving a lot of the momentum. And as you said, we might see a little bit of a spike in the VIX heading into the data, and then definitely a drop if all comes in line with expectations.
Yes, and I should just correct myself. I said 4.2% was a forecast for the unemployment rate. It's actually 4.3, which is in line with a month earlier. Perhaps I'll just quickly talk about the RBA then, if that's the case, because it's not expected to be particularly exciting, but the devil will be in the detail. Also, just draw people's attention to this rate tracker that the ASX actually produces for the RBA, and this is just the expected move. Basically, call it a 5% chance of a rate cut. Realistically, we've got pretty much market participants as well as economists of the view that rates will be held at about 3.6%. We did last week get a inflation indicator, which for those who don't follow Australian economics quite as closely as me, is something that was released post-pandemic that is on a monthly basis that offers a little bit of a bridge between what is here still a quarterly inflation official release in the country. It has to be said that changes in November. So good to know we actually fall in line with the rest of the world come November and have a monthly inflation release, an official monthly inflation release from then. But the indicator last week was a little bit stronger than expected, came in at 3% on a headline basis. Trim mean was a little bit lower, 2.6%, but it raised concerns that maybe inflation hasn't been extinguished the way that perhaps a few months ago everyone had thought, or at least hoped it would be. And the timeline of a rate cut has therefore been deferred. There was a cut basically fully baked in for December up until a couple of weeks ago. That's been pushed back to March now. And this meeting tomorrow, especially considering it's not coming with an updated set of forecasts, will be very much focused on the language about inflation and the RBA's comfort or discomfort with the direction of travel potentially with inflation, and whether that may impede its ability to cut interest rates to support a labour market, which is clearly softening. Our last employment report revealed a contraction in employment of about 5,000 jobs, which was quite unexpected. So keep an eye out for that guidance. If they come out a little bit hawkish or at least defer a little bit more to their inflation side of their mandate, that could, have an effect on the ASX 300. Weaken the Aussie dollar too, which incidentally has been pretty much in an uptrend for most of the year, largely because of course, the weaker US dollar right across the board. But in saying that, if they come out, maybe express that they're confident that the next official inflation release, which is at the end of October, is expected to come in line with their forecasts, that may bring forward again those rate cuts and have a bit of a downward impact on the Aussie dollar, a bit of an upward effect on the ASX 200. So that'll be 2:30 in Australian time. Obviously, quite early in the morning in Europe, but nevertheless, if you're an Aussie dollar trader, keep an eye out for that. Danny, let's perhaps open up to some questions if there happens to be any. We've got quite some time to tackle, but for me, it's pretty indicative of the fact that for all the things that could be going on at the moment, they're not. It's a very, very low volatility environment. We do have a few questions here. There's a few questions, probably nothing that I don't know, Danny, if you're looking at them, nothing that we could probably add too much
Yeah.
color on. I mean, the Argentina situation, obviously there's a bailout package. I don't really have a strong view on that other than to say that, effectively it does, support, obviously, Argentina's debt markets and give that a little bit of time. There was a period there, obviously, at the start of the year where the markets were really heralding Malay's policies as that kind of shock therapy as being something that would provide, a little bit more permanent confidence for markets in Argentina's fiscal position, but clearly that's deteriorated. Um,
Yeah,
uh,
I think if you trade Argentinian assets, Argentinian bonds have rallied on the back of it, assets as well. If you're trading the peso, that's definitely something to watch out for. When it comes specifically to US assets, I think the impact is very, very low, especially considering what's on the table right now, domestically.
Yeah, well, I mean, I think sort of a reference to South American stocks again is not something that we really follow too much, unfortunately. So probably that's as much color as we can provide. Probably penny stocks too. I mean, there's a question about any penny stocks in the sites. We don't really sort of follow penny stocks particularly much, but it is worth saying that we are seeing signs of outperformance in small caps, as well as maybe some speculative activity in companies that might be considered pre-profit, is the euphemism, which may be indicative of two things. One, the fact that, maybe we're hitting an inflection point in the cycle, and something expansionary is ahead because of interest rate cuts. Maybe there's the argument there's some irrational exuberance in the market as well. Danny, we've also finally got one on copper too. I can get the chart up.
Yep.
We did have a little bit of a rebound because of a fairly significant story when it comes to I think it was the supply side of the copper market last week, but it does seem like we're sort of grinding ourselves, at least when it comes to the is this the LME price or is it the US price of copper after that big shock that we got a couple of months ago?
Yeah, we've seen some upside. I think there was a story as well last week. Something I have to say I haven't followed this too closely, but I saw reports about copper prices actually jumping towards mid last week, which is actually when we saw some increased interest from our own clients at Capital.com trading copper. I think one of the mines, Freeport mine, had to close for a few days. I think they had an accident or something that limited their lines, and I think that saw some uptick in copper prices. But if we're looking at the chart, a lot of that actually stabilized there. I think you've got that one daily candlestick there where you see that jump based on some of those news coming through. Other than that, pretty stable market. We saw, of course, as you were highlighting there back in July, a lot of that volatility was based on headlines about Trump and tariffs. And once that died down, we saw this pretty much very stable price environment for copper. Yeah, I think as you see, we're back stabilized a little bit there. And I think it's just a case of waiting for some of those catalysts and drivers to come through. The RSI is, I think, was nearing that overbought region, but you can see how little those daily moves actually move the RSI. So it kind of shows that low volume market the copper price is currently in.
Yeah, and just to clarify on the news there was a landslide in Indonesia at a major copper mine. So that's what I was we were thinking of. Nevertheless, I think that might be all from a question front. We're a few minutes ahead of schedule, but a short webinar is a good webinar. Danny, we may as well wrap it up there.
Yeah, I said, it's not the biggest impact week this week in markets, so volatility may be a little bit subdued. Of course, might creep up specifically in the VIX towards the end of the week with that PCE data, which is going to be the key event in market. Sorry, not PCE, my bad. PCE was last week. NFP data. So watch out for that. Any deviations from expected, that's when we can see a little bit of momentum in markets likely coming on Friday.
Indeed. All right. Well, we'll pick it up this time next week and digest it all. But Danny, great to have your company. Thanks for everyone who tuned in. Of course, please like, share on YouTube. We do record these webinars so you can watch them back and hopefully share them with your friends. So bring as many people you can along. Otherwise, please, happy trading. Let's pray for some opportunities out there this week. Maybe just a nice, healthy dose of volatility. But otherwise, go well, and we'll see you soon.
Have a good week, guys. Bye.